Hello and welcome to the Wealth Wisdom Tube, our own hub for financial freedom. Definition of investment. Investment refers to the act of committing money or capital to an asset or venture with the expectation of generating a profit or return. The assets that individuals invest in can include stocks, bonds, real estate, mutual funds, exchange-traded funds, ETFs, and more. Investors may choose to invest in these assets for various reasons, such as capital appreciation, dividend income, or interest income. Essentially, investment involves putting money to work in order to generate returns that exceed the initial investment. Importance of investment. Investment is an essential part of personal finance and wealth building. By investing, individuals can grow their wealth and generate passive income that can help them achieve their financial goals. For instance, investing can help individuals save for retirement, pay for education expenses, or buy a home. By investing in assets that provide returns over time, individuals can build a nest egg that can support them in the future. Additionally, investment can help protect wealth from inflation, which erodes the purchasing power of money over time. For example, if an individual saves $100 today, inflation may reduce the value of that $100 to $90 in a few years due to rising prices. By investing, individuals can aim to earn returns that keep pace with or exceed inflation, which can help preserve their wealth. Investment also plays a significant role in the economy by providing businesses with the capital they need to grow and create jobs. Investors who buy stocks or bonds are essentially lending money to companies or governments, which can then use the capital to invest in research and development, expand their operations, or finance infrastructure projects. This investment can drive innovation and economic growth, which benefits society as a whole. Therefore, understanding investment and how it works is critical to achieving long-term financial success. By making informed investment decisions, individuals can take control of their financial future and achieve their financial goals. 1. Types of investments. A. Stocks. Stocks, or equities, represent ownership in a company. When an individual buys a stock, they become a shareholder in that company, which gives them the right to vote on corporate decisions and receive a share of the company's profits in the form of dividends. Stocks can be purchased directly from the company through a stock purchase plan or from a stockbroker on a stock exchange. The value of a stock is influenced by a variety of factors, such as the company's financial performance, industry trends, and overall market conditions. Investing in stocks can be risky, as the value of a stock can fluctuate widely and investors may lose money if the company performs poorly. B. Bonds. Bonds are debt securities issued by companies or governments to raise capital. When an individual buys a bond, they are essentially lending money to the issuer, which agrees to pay the investor back with interest at a future date. Bonds can be purchased directly from the issuer or through a broker. The value of a bond is influenced by factors such as interest rates, credit ratings, and the financial stability of the issuer. Bonds are generally considered less risky than stocks, as they provide a fixed income stream and are less likely to experience significant fluctuations in value. C. Mutual funds. A mutual fund is a collection of stocks, bonds, or other assets managed by a professional fund manager. Investors can purchase shares in the mutual fund, which gives them exposure to a diversified portfolio of assets. The value of a mutual fund is determined by the performance of the underlying assets. Mutual funds can provide investors with diversification, as well as professional management, which can help minimize risk and maximize returns. D. Exchange-traded funds, ETFs. ETFs are similar to mutual funds in that they offer investors exposure to a diversified portfolio of assets. However, ETFs are traded on stock exchanges, which means that they can be bought and sold throughout the day like stocks. ETFs can provide investors with diversification and low fees, as well as the flexibility to buy and sell shares at any time. E. Real estate. Real estate investments involve buying and owning property, such as residential or commercial real estate. Real estate investments can provide investors with rental income and the potential for capital appreciation, as property values may increase over time. Real estate investments can be made directly, by purchasing property, or indirectly, through real estate investment trusts, REITs, or real estate mutual funds. F. Commodities. Commodities are raw materials and natural resources that are traded in commodity markets, such as gold, silver, oil, and agricultural products. Commodities can provide investors with a hedge against inflation, as their prices may rise along with inflation. However, commodities can also be volatile and subject to sudden price fluctuations. Cryptocurrencies. Cryptocurrencies are digital assets that use cryptography to secure transactions and control the creation of new units. Bitcoin, Ethereum, and Litecoin are examples of popular cryptocurrencies. Cryptocurrencies can provide investors with the potential for high returns, as their prices may rise rapidly in response to market demand. However, cryptocurrencies are also highly volatile and may not be suitable for all investors. Investment strategies. Investment strategies are approaches investors use to select investments that they believe will help them achieve their financial goals. Different investors have different goals, risk tolerance, and investment horizons, so the investment strategies they use will vary. Here are some common investment strategies. Value investing. Value investing is an investment strategy that involves buying stocks that are trading at a price that is lower than their intrinsic value. This approach involves analyzing a company's financial statements and looking for companies that are undervalued by the market. The goal is to buy these stocks at a discount and hold them until the market recognizes their true value. Growth investing. Growth investing is an investment strategy that involves buying stocks of companies that are expected to grow at a faster rate than the overall market. This approach focuses on companies that have a proven track record of strong earnings growth, and that are expected to continue to grow at a faster rate than their peers. Income investing. Income investing is an investment strategy that focuses on generating a regular income stream from investments. This approach is popular among investors who are retired or nearing retirement and are looking for investments that will provide a steady income stream. Examples of income investments include bonds, dividend-paying stocks, and real estate investment trusts, REITs. Index investing. Index investing is a passive investment strategy that involves investing in an index fund, which tracks a specific stock market index, such as the S&P 500. This approach is popular because it offers broad market exposure, diversification, and low fees. Investors who use this strategy are essentially betting on the overall growth of the market rather than on individual stocks. Active investing. Active investing is an investment strategy that involves actively managing a portfolio of stocks, bonds, or other investments. This approach involves analyzing the market, conducting research on individual stocks, and making buy and sell decisions based on this analysis. Active investors believe that they can outperform the market through their skill and expertise. Passive investing. Passive investing is an investment strategy that involves investing in a portfolio of stocks, bonds, or other investments with the goal of matching the performance of a specific market index. This approach is popular because it offers low fees and is relatively easy to manage. Passive investors believe that the market is efficient and that it is difficult to consistently outperform the market over the long term. Portfolio construction. Portfolio construction is the process of selecting and managing a group of investments that align with an investor's financial goals, risk tolerance, and investment horizon. Here are some important aspects of portfolio construction. Asset allocation. Asset allocation is the process of dividing an investment portfolio among different asset classes, such as stocks, bonds, and cash, based on an investor's financial goals and risk tolerance. The goal of asset allocation is to create a diversified portfolio that can help an investor achieve their financial goals while managing risk. Diversification. Diversification is the process of spreading investments across different asset classes, industries, and geographies to minimize risk. The goal of diversification is to reduce the risk of a single investment or sector negatively impacting the overall performance of the portfolio. Diversification can also help increase returns by allowing investors to benefit from different sources of return. Rebalancing. Rebalancing is the process of adjusting the allocation of investments in a portfolio to maintain the desired level of risk and return. Over time, the performance of different investments in a portfolio can cause the allocation of assets to deviate from the desired allocation. Rebalancing involves selling assets that have performed well and buying assets that have underperformed to bring the portfolio back to the desired allocation. Risk management. Risk management is the process of identifying, analyzing, and mitigating risks associated with investing. Investors must assess their risk tolerance and invest in a portfolio that aligns with their risk appetite. Risk management also involves diversification, as mentioned earlier, and ensuring that the portfolio is well positioned to weather changes in the market. Portfolio construction is an ongoing process that requires regular monitoring and adjustment. Investors must regularly review their investment portfolios to ensure that they are on track to achieve their financial goals and make adjustments as necessary to ensure that their portfolios are well positioned to manage risk and maximize returns. Risk management. Risk management is an important aspect of investing that involves identifying, analyzing, and mitigating the risks associated with investing. Here are some important aspects of risk management. Risk versus return trade-off. The risk versus return trade-off is a fundamental principle of investing. Investors must be willing to take on some level of risk to achieve higher returns. However, the level of risk an investor is willing to take should be balanced with their financial goals and risk tolerance. The higher the risk, the higher the potential return, but also the higher the potential loss. Investment risks. There are various types of investment risks that investors should be aware of, including market risk, interest rate risk, credit risk, inflation risk, liquidity risk, and geopolitical risk. Market risk is the risk of loss due to changes in the market. Interest rate risk is the risk of loss due to changes in interest rates. Credit risk is the risk of loss due to the default of a borrower. Inflation risk is the risk of loss due to changes in inflation. Liquidity risk is the risk of loss due to the inability to buy or sell an investment quickly. Geopolitical risk is the risk of loss due to political events or instability. Investment risk management techniques. Investors can manage investment risks by diversifying their portfolios, using stop-loss orders to limit losses, and investing in assets that are less risky. Diversification involves spreading investments across different asset classes, industries, and geographies to minimize risk. Stop-loss orders involve setting a limit on how much an investor is willing to lose on an investment. Investing in assets that are less risky, such as bonds, can also help manage risk. In conclusion, understanding investment performance is crucial for investors to make informed investment decisions. Measuring investment performance, benchmarking, investment returns, and historical investment performance are all essential components to gauge the performance of an investment. And that concludes our discussion on investment. We hope that you found this video informative and helpful in understanding the different aspects of investing. Remember that investing is a long-term process and requires patience, discipline, and a solid strategy. As you embark on your investment journey, make sure to always do your research, diversify your portfolio, and manage risks effectively. If you enjoyed this video and would like to see more content like this, please subscribe to our channel and turn on the notification bell to stay updated on our latest videos. Thank you for watching, and we'll see you in the next one.